The nature of money and its creation is often misunderstood. Most people assume that money is simply printed by the government or issued by central banks, but this is not how the vast majority of money enters circulation. In reality, the system of money creation is far more complex and is dominated by commercial banks. In today's discussion, we will explore the mechanisms behind modern money creation and correct widespread misconceptions. The financial crisis of 2008 raised many questions about the functioning of our monetary system. Chief among them, where did all that money come from? And where did it go? How is money created and distributed in the economy? And why does the system work the way it does? These are crucial questions, the answers to which form the foundation of understanding modern economics. We will begin by defining what money is and exploring how it is created in the modern economy. Following that, we will address popular misconceptions about banking, focusing on the difference between the textbook version of banking and the reality. Finally, we will examine the true process of money creation, led primarily by commercial banks, and the implications this has on financial stability and economic growth. To understand the mechanics of money creation, we must first define what money is. Money, in its simplest form, is anything that is widely accepted as a means of payment, especially by the government. In modern economies, money takes three primary forms: cash, central bank reserves, and commercial bank deposits. Cash is the physical currency in circulation, including banknotes and coins. However, cash represents only a small fraction of the total money supply, less than 3% in most developed economies. Central bank reserves are electronic balances held by commercial banks at the central bank. These reserves are used for interbank payments, but are not accessible to the general public. The third and most significant form of money is commercial bank deposits. These deposits are created by commercial banks when they issue loans. When a bank approves a loan, it does not transfer money from existing deposits. Instead, it creates a new deposit in the borrower's account. This process increases the total amount of money in the economy. In fact, over 97% of the money circulating in the UK is in the form of commercial bank deposits. It is important to understand that money created by banks through the process of lending is treated as money in the economy. It is used for transactions, and for most people, it is indistinguishable from cash. Yet, this money does not physically exist in the same way that banknotes do. It is purely an electronic record created when a bank extends credit. It is a common belief that banks function as simple intermediaries, taking deposits from savers and lending this money out to borrowers. However, this perception is inaccurate and fails to capture the true role of banks in the modern economy. In reality, banks do not wait for a customer to deposit money before they can make a loan. Instead, the creation of a loan by the bank simultaneously creates a new deposit in the borrower's account. This process is not the redistribution of pre-existing money, but rather the creation of new money in the form of credit. It is important to note that this newly created money functions as actual money in the economy, even though it is purely electronic. This misunderstanding of how banks operate leads to significant misconceptions about the money supply. Many still believe that the amount of money a bank can lend is directly linked to its reserves. In reality, the ability of banks to create new money is only weakly connected to the amount of reserves they hold at the central bank. For example, in the lead-up to the 2008 financial crisis, banks held just £1.25 in reserves for every £100 issued as credit. One of the common ways banking is taught in textbooks is through the concept of fractional reserve banking. This model suggests that banks lend out most of their deposits while keeping a small fraction as reserves, which supposedly limits their ability to lend. While this explanation captures part of the process, it is incomplete. The reality is that banks are not constrained by their reserves when they create loans. Banks do hold reserves, but these are not a direct limiter on their ability to issue loans. In fact, the central bank often adjusts its provision of reserves to ensure that the banking system functions smoothly, rather than controlling the amount of lending directly. Commercial banks create money through lending, and the reserves follow as needed to support liquidity in the system. A core function of commercial banks is to create money. The popular view holds that banks operate as mere intermediaries, transferring money between savers and borrowers. However, this is not how money creation occurs in modern banking systems. When a bank grants a loan, it simultaneously creates a corresponding deposit in the borrower's account. This deposit functions as money in the economy, even though it is not physical cash. Thus, money is created not by transferring funds from one account to another, but through the very act of extending credit. The process of creating money begins when a customer requests a loan from a bank. Once the loan is approved, the bank credits the borrower's account with the loan amount. This credit is not drawn from existing deposits or reserves. It is newly created. The borrower can then use this newly created money for purchases, which adds to the total money supply in the economy. It is essential to understand that the money supply is not solely determined by central banks. Instead, commercial banks play a crucial role in determining how much money circulates in the economy. This process explains why the vast majority of money in circulation, around 97% in developed economies, is electronic money created by commercial banks, not physical cash. After the borrower uses the money for a purchase, the funds are transferred to the seller's bank account, and the balance is adjusted. Most payments in modern economies are settled electronically without any physical transfer of cash. These transactions take place through clearing systems that reduce the balance in one account while increasing it in another. This system of clearing and settling payments has been a feature of banking since its early history. Today, the vast majority of transactions by value occur through this electronic clearing process, illustrating the minimal role physical cash plays in the economy. A common misconception is that banks can only lend money based on their reserves. However, the ability of banks to create new money is only weakly linked to the reserves they hold at central banks. The notion of fractional reserve banking suggests that banks must hold a fraction of deposits in reserve and lend out the rest. But this is an oversimplified explanation of how banks operate. In reality, banks hold reserves mainly to ensure liquidity for interbank transactions and to meet customer withdrawals. These reserves are not the primary constraint on lending. During the 2008 financial crisis, for example, banks held only £1.25 in reserves for every £100 issued as credit. The ability of banks to lend and create new money is not determined by the amount of reserves, but by their confidence in the borrower's ability to repay the loan. The ability of commercial banks to create new money carries significant implications for both economic stability and growth. The process of money creation through bank lending influences not only the total money supply, but also the allocation of resources across different sectors of the economy. Understanding these implications is crucial for grasping the dynamics of modern economies. One of the most profound impacts of commercial bank money creation is its role in driving credit booms. When banks create money by issuing loans, they increase the money supply, which can stimulate demand and lead to economic growth. However, when too much credit is extended, particularly in speculative sectors such as real estate, this can lead to asset price bubbles. Once these bubbles burst, the result is often a financial crisis. This cycle was evident during the 2008 global financial crisis, where excessive lending to the housing market played a central role in triggering a worldwide economic collapse. Capital adequacy requirements, which are designed to ensure that banks maintain a buffer of capital relative to the loans they issue, have proven ineffective in preventing credit booms and asset bubbles. The financial system's ability to grow unchecked in times of confidence means that even with regulatory safeguards, the risk of unsustainable credit growth remains. As banks increase lending, their balance sheets expand, and while capital requirements provide some restraint, they do not fundamentally limit the amount of new money that can be created. The consequences of unregulated credit expansion are severe, as seen in multiple historical financial crises. The decisions banks make regarding whom to lend to and for what purpose have significant economic implications. Banks often prioritize lending against collateral, particularly in sectors like real estate, where they can secure their loans with physical assets. This preference for lending to purchase existing assets, rather than financing new productive investments, leads to resource misallocation. Instead of supporting innovation and the growth of small businesses, much of the newly created money flows into speculative markets, inflating prices and contributing little to actual economic productivity. This misallocation exacerbates inequality and limits long-term economic growth. An important point often overlooked is the relationship between fiscal policy and money creation. Contrary to popular belief, government spending and taxation do not directly influence the total money supply in the economy. While governments can influence demand through spending, the actual creation of money is primarily in the hands of commercial banks. This means that fiscal policies aimed at stimulating growth may be limited in their effectiveness if they do not align with the broader credit conditions set by banks. The ability of commercial banks to create new money has significant economic implications. Banks, through the process of issuing loans, effectively decide where new money enters the economy. This grants them considerable influence over the allocation of resources. When banks decide to issue credit, they are shaping not only the availability of money, but also which sectors of the economy receive that money. Often, this results in money being directed towards areas where banks feel confident they will receive returns, such as real estate and financial markets. The money supply in modern economies is largely driven by commercial bank lending, and the vast majority of money is created in this way. This differs from the perception that central banks are primarily responsible for money creation. In fact, the money that circulates in our economy is mostly electronic, created by private banks through the issuance of loans. The ability of commercial banks to create money can lead to financial instability, especially when too much money is funneled into speculative areas like property and financial assets. Credit booms driven by excessive lending often result in unsustainable asset bubbles, which can eventually burst, leading to economic downturns. The 2008 financial crisis is a clear example of how unchecked credit expansion fueled by commercial banks can destabilize entire economies. This cycle of boom and bust, driven by credit creation, is an inherent feature of the current monetary system. During periods of economic optimism, banks are more willing to lend, which increases the money supply and fuels growth. However, during downturns, banks restrict lending, which reduces the money supply and exacerbates the economic contraction. One of the major challenges in regulating this system is that traditional tools, such as capital adequacy requirements, do not effectively constrain money creation by banks. These regulations are designed to ensure that banks maintain a certain amount of capital relative to their loans, but they do not directly limit how much money banks can create. As a result, even well-capitalized banks can contribute to credit booms if they continue to extend large amounts of credit during periods of economic optimism. This creates a regulatory dilemma. How can policymakers ensure that banks provide sufficient credit to support economic growth without allowing the money supply to expand to unsustainable levels? This balancing act is complicated by the fact that banks are not simply intermediaries, but active creators of money. The existing regulatory frameworks, which focus on maintaining bank liquidity and capital buffers, have proven insufficient in preventing crises such as the 2008 financial meltdown. Banks tend to prioritize lending to areas where they can secure their loans with collateral, such as real estate and financial markets, rather than lending to sectors that are productive but riskier. This results in a misallocation of resources, where money is directed towards speculative investments rather than productive industries that drive economic growth. The preference for lending against collateral leads to inflated asset prices, particularly in the housing market, contributing to wealth inequality and economic instability. This issue is compounded by the fact that banks have the power to decide where new money enters the economy. They are more likely to lend to sectors where they can secure returns, rather than to industries that may have long-term benefits for economic development. This misallocation of credit exacerbates income inequality, as those with access to capital benefit from rising asset prices, while others are left behind. The power of commercial banks to create new money, which they do primarily through issuing credit, has significant implications for both financial stability and economic growth. As we've discussed, most money in circulation is not created by central banks, but by private banks when they extend loans to businesses and individuals. This money creation process directly impacts the economy by influencing which sectors receive funding and how much credit is available. The ability of banks to decide where new money enters the economy grants them immense power. In particular, banks often prioritize lending to secure investments, such as real estate, rather than to riskier but potentially more productive sectors like small businesses and startups. This misallocation of credit can contribute to rising inequality and asset price bubbles, which destabilize the economy. That wraps up our exploration of how money is really created in the modern economy. I hope this video has shed some light on the crucial role banks play in money creation and how it affects our everyday lives. If you found this video insightful, make sure to give it a thumbs up and subscribe for more content on economics and finance. Don't forget to hit the notification bell so you don't miss any updates. I'd love to hear your thoughts. What surprised you the most about money creation? Let me know in the comments below. Thanks for watching, and I'll see you in the next video.